I'm talking in the first part of my talk about my joint work with Carmen Reinhardt and that work surrounding it, where we emphasize the importance of having long-dated cross-country quantitative perspective. We look at all kinds of financial crises: exchange rate, inflation, domestic, external, banking. Often these are interlinked. And there's certainly been a lot of work that we build on. It's, I hope, cited very thoroughly in our book. But I would stress that a lot of it was narrative. The finance minister felt really bad that they were going to have to default the next day and not necessarily putting together as systematic and extensive a quantitative data set. And the idea, when we first set about this in 2002, our book was published in 2009, was to have something that would be useful for thinking about all kinds of crises in the future. To say we anticipated the financial crisis is not true. I would be donating to this forum instead of speaking at it. But we probably were thinking about Argentina, Turkey, Brazil maybe happening again, and who knows. The idea of having such a broad-based data set is simply that it's very hard with a small amount of data, particularly on one country. Martin Heldwig spoke in the last session that tries to capture things. I would say one conclusion we come out with of the research is that advanced countries are not so different, and not all countries are so advanced. Italy, I'm sorry, is not exactly the same as the United States. Greece is not the same as Italy. And frankly, if you're living in my country these days, the United States does not feel like the United States. And I think Carmen, there's a later session on financial crises. Carmen Reinhardt will talk much more depth, but I certainly think a part of our work helped informed policymakers during the financial crisis. And the most important point we had is that if you have a deep system, if you have a recession that is marked by a deep systemic financial crisis, it's likely to be very severe, the recovery more U-shaped, not V-shaped. A very important point I want to make is the last one in this slide, that although these historical benchmarks we think are useful, they are hardly the be-all and end-all of thinking about things. They are a starting point for policy analysis, for scholarly analysis. We think we were very informed by the theory. We certainly cited a lot of you. And we like to think that there's been some feedback. I'll talk about some particular areas. Okay, so I won't get into these, but we had, looking at markers of whether the US might have a financial crisis, we had papers on that in advance of the financial crisis. And one thing we looked at was banking crises, having tried to do a very extensive dating of them, following the work of many scholars, including some here. And one point we made, and again, hearkening back to something Martin said, is the advanced countries are not so equal. We have a couple chapters built around the idea that maybe they're an equal opportunity menace. These are select markers from our extensive data set of what happens. The duration actually represents how long it takes to go down. It's not how long it takes you to recover. We in our 2014 paper, looking over 100 crises, find that to be much longer, more on the order of 8 years. But what in putting together our data set around financial crisis, there were a number of things people didn't have before. A very central one was housing prices. Now, you think of that, especially if you're like the many people who looked a lot at the United States, you think, well, obviously it's housing prices. But that data wasn't available to scholars. We constructed it with a very big assist from the BIS, who had sort of secretly been keeping a data set on this, that a research assistant on his last day after working for 30 years at the BIS released to us. We're very grateful. So another, and you'll see much more work later by Atif, Allen, and others with housing. Debt data, I think, is the most remarkable part of the data set we put together. We wanted to have debt data around financial crisis, and it's actually not very easy to come by. So this marks what happens to public debt on average 3 years after a financial crisis. It rises by over 80%. On the right-hand side, you see that for advanced economies that had systemic financial crisis, it was only 50% in the first 3 years. And you can say, well, maybe they didn't do enough countercyclical policy. I'll come to talking about that connection. It's very fundamental. So just to be clear, private debt causes financial crisis, at least in market-based economies, not public debt. The public debt is a piece of how you get out of financial crises. And maybe to anticipate a point I'm going to make later, your credit line being good is not the same for everyone. The sovereign doom loop we saw was no unusual thing. And so that's also an important feature. And Reinhard and I had a later paper about including a lot of emerging markets, how public debt crisis would sometimes happen after, sometimes years after, a deep financial crisis. But I'll get back to the data, which is really important in a bit. So I'm going to turn now to talking about default on debt. I know there's a certain end of history mentality that that's never going to happen again. I want you to understand I'm talking about the whole world. I'm not just talking about the United States. The US is 5% of the global population. The advanced economies, maybe 15%. Very soon, emerging markets, will be a dominant part of the world economy. They do default on their sovereign debt, and I think it's something for empiricists and theorists to think about. And again, to mention the sovereign doom loop that we saw in Europe was this: if you're giving bank bailout guarantees and somebody needs to bail you out when you do that, thinking about debt is integral. One of the themes that emerges from our work is that advanced countries they're different, but they're not so different. They're not all so advanced. Is that if you look over longer periods, certainly the default on external debt was not an uncommon phenomenon. We have Spain as the all-time record holder. Venezuela is coming on strong. But France had 9 external defaults. We'll talk later about modern times. They don't necessarily do outright debt defaults, although it's happened more recently than you think. But if you look at default through inflation, default through financial repression, it's more common. This is a graph from our book giving the cycles of default. This is default on external debt, where times 50% of countries are in default, and you can do it weighted by world GDP, and it's still pretty impressive. This approach of having a quantitative data set, I think, is useful for thinking about debt, and both from an academic and policy point of view. This chart is really sort of first from this 2003 paper with Miguel Savastano, where we're looking at what was external debt to GDP in the year of the restructuring. And you see that in over 50% of the cases, it was under 60%, which we think of as a safe level. In my work in the 1980s with Jeremy Bulow, we observed something similar about transfers, that countries seemed to default when they were just asked to transfer a couple percent of GDP, and that seemed to lead to a default. The Europeans, parenthetically, are very proud of Belgium, transferred something like 4% of GDP for a few years, but it's unusual. We term this debt intolerance. I have to say I was just in Argentina for a conference, nothing to do with anyone wanting to talk to me. But everybody's saying, oh, well, how can they be in default? They barely have a 40% debt to GDP ratio, external debt. They don't know anything. You look at the history of Argentina and where they default. The default thresholds and probabilities are very country specific. It's not so surprising, and we can come to other countries. I won't pick on any one. I want to spend a little bit of time talking about the theory of sovereign external default, partly because it's near and dear to my heart, and Reinhard and I spend quite a bit of time on this in our book. But also, I think it shows where there's some missing pieces in the theory that need to be filled in, and also, I think, has some practical use. So, to make a long slide very short, John Eaton and Mark Gersowitz had a seminal paper in 1981 where they emphasized willingness to pay as the big deal. They emphasized exclusion from credit markets as due to reputational loss as why you repay. That's why foreigners are willing to lend to you. Now, as people have tried to make this empirical, and Maury and I did in our 1996 book, and Gopinath, I don't have it here, Aguiar and Gopinath, a very well-known JP paper, I think 2006, they find they need to put a really big fudge factor to get it to work. It's similar to all the other paradoxes about consumption volatility. And Uribe and Schmidt-Grohe actually start out their book on international finance. It's a very good book, talking about we've got to have a different framework here because this isn't working. There are different frameworks. I don't have time to go through them, but Jeremy Bulow and I had a series of papers in the late 1980s trying to develop a bargaining theoretic framework where we made a big deal about legal enforcement, and it made a big difference if it was in domestic courts or foreign courts. And we argued this explained a lot of issues that you couldn't explain otherwise, having to do with why debt agreements take so long to reach. Reinhard and I have a lot of benchmarks about this, why the IMF and World Bank get sucked in, why you don't really observe senior debt tranches in international lending. I don't have time to go through all that, but I think this framework can explain it. One application of it, again, this is taking theory, there's other cuts you can take. During the 1980s, tens of billions of dollars in poor country money and the money of would-be people giving aid to these countries and multilateral institutions was spent on debt buybacks at market prices. And this was viewed as a heroic measure. I won't go into the details, but I think Bulow and I show rather convincingly, and Reinhard and I discuss it further, this was just a giveaway to creditors because it's not corporate debt, it's sovereign debt. And in sovereign debt, what you can do to squeeze the debtor doesn't really depend on the cash they have that you can't get at. It depends on your ability to interfere with their trade, interfere with their future borrowing. Anyway, having the right model is significant for trying to think about policy. Now, the theory of domestic debt is actually far less well developed. There are a number of reasons for this. I mean, a lot of papers just assume it's always repaid. I think that I note, though, some papers by Kotlikoff, Pearson, and Svensson, also Tabellini, which try to have a sort of super game view of this. But I think part of the reason this wasn't so developed is there was a view that there wasn't really so much of it, that it wasn't a big deal. And if Argentina has some domestic debt, they'll just inflate it away. Who really cares? It doesn't affect anything. In fact, there has historically been a lot of domestic debt, even in these countries. We'll show you the data in a second. And there have been defaults on it. Just outright defaults, not just inflation. So if you look at external debts, it's very well documented. Winkler, Wynn, Eichengreen, and Lindert. By the way, I have to pause. The 1928 book by Max Winkler is just incredibly great. he latched onto this topic ahead of everyone else and obviously had so much fun writing it about all the history of defaults. But when you come to the case of default on domestic debt, it's just very little systematic research. Basically, people have been largely unaware of this. Now, it's not just the defaults that didn't exist, and this is the hard part, really hard part to get your head wrapped around. You couldn't get the data on what public debt was, plain vanilla public debt. I showed you that earlier slide and said, you know, it didn't exist before. So for the US now, it's something like $21 trillion. The US, the UK have very good series. When we did our first paper with Savastano, you couldn't get it for any of the emerging markets back more than 5 years. And I used, you know, my power as chief economist at the IMF to squeeze people, to search around the world. We got a little bit of data for some countries. Even for the OECD countries, you couldn't get it back very far in any way that wouldn't take you months and months of work. And so we put together a data set. We discuss in the book the archaeological process of doing it. The IMF, back in my day, was doing debt sustainability data exercises without knowing what the domestic debt was, not even knowing that it existed, or maybe assuming, you know, it would just get paid. And there was a belief, I think it was also ingrained in academics, that it didn't exist. And it's a prime example of what Reinhardt and I call hidden debts. In fact, they were very large. This is as a percent of total debt, but the red dashed lines, even for Latin America. They were very large around default episodes. The dark bar is external debt. The light bar is total debt. These are some examples where you give the year of default, external public debt, total public debt. And the internal debt defaults were something, I think, that were by and large pretty severe. One other topic I have to mention before I leave domestic debt. I certainly over the years have taught seniorage, and everybody has. The famous Kagan 1956 paper saying, boy, it's so weird that they inflated too much. It was too fast. It was suboptimal. They were inflating so fast they weren't maximizing revenue. Well, in all of these episodes, and many were looked at in that literature, there was a lot of domestic debt where the data hadn't been compiled, but there was a lot of domestic debt. And it might have made a lot of sense to inflate, and you're not capturing the whole benefits to this unanticipated inflation. Okay, let me spend my last few minutes briefly talking a little more about, Lars is very efficient with the science, which is an innovation. Talking about the drawbacks to domestic debt for advanced economies. One point that's come out in recent research that makes a lot of sense, Romer and Romer find that if you've had a financial crisis, you do better when you have fiscal space. Jorda, Shalaric, and Taylor, Bordeaux and Meisner, also the IMF, have similar results. Again, debt matters because your bank bailout guarantees are only as good as the government balance sheet below them, and so cite a paper by Schneider and Tornell. Having a good balance sheet, and we're talking about pension, unfunded pension liabilities, everything, obviously is good for dealing with all kinds of shocks. And in later work after the book, Reinhardt, Carmen Reinhardt, also Vincent Reinhardt, we talk about medium-term average growth. It's much more speculative than the book, but I think the further research has largely supported that. One thing we show in our work is that defaults are more common than you think on advanced economies, and if you start to talk about financial repression, inflation, it's much more common. I'm glad that Emmanuel presented at the end his work with Maggiore. That's a fantastic paper, which kind of makes the point that if we look over the beginning of the paper, and then they have a model, if you look over long periods, they model why. They look over long periods, the safe assets aren't always so safe. And people believe it, and it comes crashing down. Sebastian Edwards actually has a nice book about the U.S. in 1933. I think a question mark going forward is we have independent central banks with inflation targeting. I shamelessly will mention my 1985 QJA paper, which introduced the idea of using the independent central bank to try to deal with the credibility problems. And I'll also say I couldn't get it published for the longest time, not because of any particulars about the inflation target or nominal GDP targeting, but the referees wrote back that it would be a sham having an independent central bank. It'd have no credibility. And there is literature now. Aguiar, Amador, Fari, and Kopanov have a nice paper asking the question, if you're inflation targeting really rigidly, what are you going to do when Donald Trump knocks on the door, and says, oh, I shouldn't have said anything, knocks on the door and, says, I have a problem? I think that's a tension going forward, and how to resolve that tension. Could there be a return of fiscal dominance, I think is an interesting question. I want to just stress that when we're talking about debt or fiscal policy, it is political. And sort of writing down a sterile ISLM model is missing a big part of the fact that debt and fiscal policy is a political equilibrium. And I'm referring to work by Alesina and Tabellini, Pearson and Svensson and others, and some of my own work about this issue. Don't have time to talk about negative interest rates, but I do want to say that the view that nothing bad can happen again, which is very common today, rings a lot of the great moderation and we can never have a banking crisis. And not to sound like a crazy person, but just to list a few things, there are future financial crises. As I work on cyber currencies, I've learned more about cyber warfare, pandemics, and then obviously you can have governments. Somebody writes on a model, well, I said we could have a debt of 300% of GDP. You didn't tell me you would have Beppe Grilli, become leader. You didn't tell me Donald Trump would be leader. You didn't tell me Jeremy Corbyn might win in England. That wasn't in my model, but it is in the world. And so I think it's important to resist this time as different end of history thinking and to have a panoramic cross-country perspective in thinking about monetary policy and crises of all types. Thank you.